This podcast is for professional investors only. Capital at risk. Hello and welcome to LGIM Talks. Have you ever wondered what level of maths ability is needed to work on an investment desk? How the increasing availability of market data has changed the role that maths plays in the industry, or how maths can help us understand what's really going on in markets? I'm Harry, a content manager here at LGIM, and answering these questions and more today are two senior investment heads with heavyweight academic credentials. They are Fadi Zaher, Head of Index Solutions, and Aanand Venkataraman, Head of ETFs. Welcome, Fadi and Aanand. I've been looking forward to this one.
Hi, Harry. Thank you for inviting us to this.
Hi, Harry.
So, Aanand, I wonder if you can kick us off by giving our listeners a very quick summary of the time you spent in academia and the path that led you to your current role here at LGIM.
Yeah, sure. Thanks for asking that question, Harry. So I have a background in mathematics. I did my undergrad in pure mathematics and a master's in applied, and then went on to do a PhD in mathematical finance. And then I also have a 2-year stint in university as a assistant professor, and so that's basically my academic sort of background and history. But after my PhD, I went on to join investment bank as a structurer. Worked on fixed income, FX, and commodities within the structuring desk. And then after that, ran a startup, and then joined another bank doing similar stuff within investment strategies, and then now at Legal & General for the past 7-ish years.
Thanks, Aanand. And how about you, Fadi? I know that you've worn many different hats over the years, including researching and lecturing in finance and econometrics in Sweden. How does applied maths feature in your day-to-day work here at LGIM?
Thank you, Harry. Thank you for the invitation to this interesting podcast. It's a very unusual topic, but it's actually a very relevant topic because math is actually central to everything we do, especially in my business area where we look at systematic investing, index strategies. The way we think of math actually, because it's just part of everyday life in terms of how we design strategies, math provides the rules that we basically use to construct these investment strategies. For example, take an index funds. We can say track up the performance of the UK stock market, but instead of guessing which stocks to buy, we follow a clear set of rules and formulas to ensure that we follow or at least track that market. So math kind of helps us to actually manage also our costs as well, because we could do much more with the math. We can analyze multiple markets quite systematically. Say, for example, if you buy all the stocks in a FTSE 100, it might be an expensive approach to do so. From an implementation, you might decide to effectively use math to reduce the number of stocks to buy in order to create an efficient implementation of the strategy. So really, math is quite an important part of what we do.
Thanks, Fadi. So in the introduction to this podcast, I promised to ask what level of maths is needed to work on an investment desk nowadays. I feel like the answer to that question is almost certainly it depends. But I'm interested to hear your thoughts nonetheless. In terms of asset classes, are there any that you would say are inherently more mathematical than others? Fixed income, I'm thinking of, has a reputation for being quite maths heavy. Or is it fair to say that the rise of systematic approaches to equities has made this asset class less qualitative and more quantitative than it used to be?
Very interesting question, Harry. But before I kind of talk about asset classes, right, I'd just like to take a step back and then talk about 3 broad categories where you could have math or quantitative solutions applied. So I'd say one is the pricing aspect, where you're pricing different assets, securities, derivatives, and so on. We don't tend to do that more in the asset management industry, but that's one for market makers and IBs. So those parts are very challenging. It starts with building an interest rate curve, your discount curve, all the way through to pricing exotic options and so on. But then the second and third is probably where we come in. Where one is around, say, managing money, and the other one is sort of providing solutions for clients, right? On managing money, again, you have asset class nuances. You do have systematic strategies that Fadi touched upon earlier on, and even within systematic strategies, you have varying degrees, right? You could have something as simple as a market cap based index to all the way to a high frequency Kalman filter based or fast Fourier transform or any of those sort of signal processing based technical strategies, but that's more hedge fund like. And again, with asset classes, again, you have differing nuances. Fixed income does have its own nuances, but I wouldn't necessarily say that the asset class as such is more complex. There are nuances, and it does make it very, very interesting. But depending on what you're dealing with, if you're dealing with complex derivative products in say in commodities, that could from a mathematical standpoint, it could be quite challenging as well. One other thing that we do within the wider group, which requires a lot of mathematics and also within the solutions team, is actuarial sciences. And it requires years of rigorous trainings and clearing off a number of exams and so on. But that forms the basis of most of what runs the insurance industry.
Fadi, can I turn to you to ask about the huge increase in market data of all different kinds over recent decades, and how this trend has changed the skills that are needed within the industry?
Yeah, I think it kind of links back to Aanand's answer on the different asset classes. I think the data itself, for example, in equity, has made it become more mathematically oriented to be able to find patterns. But for example, to get to the big data trend that we see today we're dealing with billions of data points from stock prices, bond prices, and even also ESG data. And it's kind of impossible for one person to really process all that information, or even a smaller group of people. So we use math and technology to kind of to help us to make sense of all this. We have tools, we use math to cut through the noise of big data.
So I'd like to turn now to the question of how maths can help us all understand markets. I wonder if either of you have specific examples of concepts from maths that can be applied to markets. Fadi, would you like to go first?
I'm sure Aanand has a lot of them given his experience, but shall I take the most common use of math, at least on a day-to-day? It's basically the risk and the reward concept. I mean, we use math to understand changes in underlying prices, which is another way of measuring, say, the returns of underlying asset class. Could be in equities, could be in bonds. So the rate of change is something we use. We use it also. Rate of change can be linked also to interest rate risks that we measure in portfolios. Changes when it comes to an economic aspect could be changes of GDP, gross domestic product. Other things that is optimization. And I'm going to mention two, and I will let Aanand to talk about maybe two others, because I guess I'm taking the most obvious one, but I'm taking more less obvious one. We use optimization, which is a mathematical concept within, say, a universe of, say, 1,000 stocks, or it could be 1,000 bonds, and you can only choose 50 of them. What is the most optimal way of choice that you can of 50 within that opportunity set that you have? So we tend to use a mathematical concept to support us in our decision making.
I'll probably just expand from where you left, really. Well, the first aspect I would say is more around pricing and forecasting. So we tend to use quite a bit of that generally within our industry. But when Fadi was mentioning about sensitivities and things like that, right? You start with something as basic as, say, a CAPM model, the capital asset pricing model, and then you look at how one security could potentially behave versus the market, and so on, right? So that would, it's a simple linear equation in mathematical terms. And if you're just looking at two assets, it is probably the most sort of basic form of that model, right? That's fairly simple. But then you can kind of add more variables and degrees of freedom and make things a little bit more complicated. And then you could end up having these, I would say, multivariable models, but could still be linear, where the price of one security could be linearly dependent on price of other securities or different factors. Now, then you're kind of adding a little bit more complexity to the problem. But regardless of that, all these models would require, in mathematical terms, something called as linear algebra. And that does play a pretty good role within mathematics and sort of within AI as well. Because I'm going to now take that another step further. And now when you kind of start adding more and more variables and parameters still within the linear framework, and then end up having multiple layers of those, then you suddenly end up having millions and millions of rows and columns, and you have these mega matrices that you need to start manipulating or inverting or running your calculations on. And that is where the I would say the whole challenge of AI comes in, because with most of these machine learning algorithms, you end up dealing with very large scale matrices. And hence, the talk of the town, NVIDIA, with their GPUs, they've ended up taking a lot of these matrix manipulations at the hardware level, and it kind of speeds things up, right? Then you're talking about more complex linear algebra matrix problems. So that's again, starting with simple sensitivity analysis to forecasting, and now all the way through to AI, you would have that thread of linear algebra and matrix manipulations kind of connecting all of these. And then now moving on to some of these optimization problems that Fadi was talking about, you could again have big baskets of stocks, whether you want to kind of allocate more or less to something based on different constraints. Then depending on how many constraints you have, how many variables and degrees of freedom you have, and how much computational resources you have, really, then you pick the most optimal optimizer, because there are different ways of optimizing, and different methods that you can use. One other thing that we do, at least within the trading team, is optimal execution. So where if you have a large block of a trade to place, then you could basically work with a broker, and some of these brokers or market makers do have their own optimal execution algorithms. And you pick one of those to sort of execute this big piece of trade automatically, and the algorithm will then decide what size I need to execute at what time during the given trade horizon, right? So those are kind of, again, it uses completely different sets of, I would say, it comes from a different side of mathematics. There's something called as Hamilton-Jacobi equation. So those are sort of, in mathematical terms, what you broadly call as elliptic equations. And then on the pricing side, you'd say there's something called as parabolic equations. And then, so yeah, you could have different shades, but I've gone from, I would say, the very simple thing of looking at sensitivity analysis and running some correlation and things like that, all the way to some of the most complex problems.
Something that interests me is the human side of all this. What I mean by that is how people's incomplete, imperfect understanding of basic mathematical concepts, or just their instinctive, innate preferences, might lead them to make irrational investment decisions. Fadi, I understand that in the factor investing world that you've got a long association with, this is an important idea, as it can provide a rationale potentially for the persistence of certain factors. I wonder if you could give us an example of this in action.
Yes, and hopefully I can try to keep the theme of math, because obviously math is really kind of powering up the factor-based investing in certain ways. But let's just remind ourselves that behavior finance shows that emotions often lead us to do or make poor decisions. So it's kind of one of the key areas within, or aspects within, behavioral finance. It's like, panic selling. People tend to kind of sell their holdings typically when market is in turmoil, or kind of become more volatile. So factor-based investing effectively, it's a systematic way of investing. It's effectively you follow a certain rules, and systematic investing solves things by using clear data-driven rules, which the rules are effectively defined by math. So just to take something maybe people can relate to, factor investing example would be like momentum stocks that tends to be rising. They often keep rising. That's the idea. Value is another kind of style or approach within factor-based investing that also relies on math, especially looking at valuations of stocks. People look at multiples. that multiples is kind of a form of ratio, could be the price to the size of the earning a company is earning. That's a mathematics, it's a mathematical ratio. So math really plays a key role here in helping us to analyze, understanding, and identifying these factors, and then in turn take them and build them into repeatable, consistent investment strategies.
So having covered quite a bit on the theoretical side, I wanted to approach this from a really practical angle. I'm thinking of any listeners who might be studying maths themselves at the moment, or perhaps they have children who are in education. What would you say about putting maths to use within the investment industry? It's a competitive world out there. So what can people who are looking to break into the industry, who have a mathematical background, do to stand out from the other applicants? Fadi, do you want to go first on this one?
I'm gonna use the same advice as I actually got over 20 years ago, and it was actually I had an opportunity to meet the renowned Professor Robert Merton, who actually won the Nobel Prize for his option pricing and corporate structure type of models. And his advice was, I think back when I had the opportunity to speak to him, I was a PhD student back then. And he said, I used always math as a tool rather than being the topic itself. So eventually over the years, I started to use math as a tool, which means that I could use the right tool for the right problem to solve a problem. So I think following that approach, it might not be just the right approach, that approach worked for me. So eventually you face a problem, you have a good basic understanding of reading mathematics, you understand data. And so combining that and addressing or deploying the right tool to the right problem by having a good knowledge of what you could use for a tool is probably an effective way. And then effectively learning by doing. I think just doing theoretical math on paper or just on the screen is good enough for kind of basic practice just to see if you understand and you can apply some of the math. But at the end of the day, you have to really put it into a real world context. And also with the emergence now with all the tools like the artificial intelligence and machine learning type of frameworks are more accessible today than probably been accessible to an average person historically. It is an opportunity to actually even do more empirical mathematics linked to finance today than it's ever been, in fact.
Great stuff. Thanks, Fadi. Anand, what would you say in your experience?
So I would actually echo the points that Fadi made. Those were quite pertinent, really. I mean, when you think about it, right? So you could either know the workings of a model, but really learn to apply that really well. So which becomes very relevant in this day and age. But at the same time, if someone is up for the challenge, you could kind of go onto the other side and then say end up building the models as well, right? So it's a question of what one wants to do. But largely speaking, within finance, you're either looking at time series data, fundamental data, or some sort of or some sort of panel data, right? Leaving some of the modeling aspects aside. So if you're sitting on the other side, working on the desk, looking to apply some of these models to make better investment decisions, then it's pretty much these data sets that you work with. Then having some insights on how the models work. And the strengths and weaknesses of different models would definitely give you a bit of an edge when it comes to sort of picking the right models to apply for the right set of data so that you get a better outcome, right? So that is one area. And on the other side, if someone wants to sort of end up developing those models or end up coding or designing those frameworks, be it right from factors to LDI problem to optimal execution problem, or building an investment strategy, then it requires some amount of coding experience, some optimization experience, and also knowing how to kind of build some of these, define these problems, and then translate them into a machine readable sort of a problem statement as well, right? So that would be more on the development side, and that's for people who want to kind of take it up as a little bit more of a challenge, really, when it comes to the complexities. But both sides are very interesting, and it ultimately depends on what one wants to do. But there are plenty of things to do, and increasingly, particularly with AI, taking shape pretty much in every sector and every part of the industry. Having a bit of a sense of how some of these models work will definitely be helpful, and that again comes with a bit of mathematical background.
Well, Aanand and Fadi, thanks both so much for taking the time to talk to me today. That was absolutely fascinating. And thanks to all of our listeners at home as well.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal and General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market, or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal and General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal and General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.